Well, thank you for joining us today for our webinar on the future of build to rent in Australia. I'm James Barlow, the Enterprise Account Manager at Altus Group, and I'll be moderating today's panel's discussion. We will be running some polling questions during the session, so look out for those. We'll hopefully have some time for some Q&A at the end. So if you have any questions, please use the Ask Question feature in the session. Joining me today, we have Niall McSweeney and Anthony Lisbona. Niall is the President of Cost and Project Management for Asia Pacific and has near 35 years of construction industry experience, having worked in Europe and Australia in all aspects of quantity surveying and construction. His experience includes developing budgets, estimates, and appraisals of alternative uses for major developments or master plans. Niall has extensive experience in public and private developments across various sectors, including build to rent. Also joining us is Anthony Lisbona, Offer Manager at Altus Group. Anthony has over 20 years of experience delivering financial modelling solutions to the real estate industry. Highly experienced in feasibility studies, highest and best use analysis, and real estate valuations. Anthony's knowledge of the build-to-rent sector, combined with modelling its complexities, is helping clients uncover opportunities and evaluate long-term performance. According to EY, the build-to-rent sector currently represents 0.2% of the total Australian residential sector. A recent report from Knight Frank expects these measures to increase the attractiveness of the sector in the long term to around 3% of the total value, equating to a potential worth of 290 billion, or the equivalent of 350,000 apartments. I know this is going to be a lively discussion. We've got a lot to cover, so let's jump in. Look, I'm going to start with you both, but we might go to you first now. BTR as a sector is the hot topic of the year. Do you see this continuing into 2024 and beyond?
Yes, James, I definitely do see this as an area where it has to grow and will grow. The current size of the market is, as you said, in relation to numbers, is very small. With a vacancy rate that is sub 1% in the market nationally, it tends to say that there's definitely room for further growth. But the real numbers sort of putting on those percentages earlier on, that 0.3% equates to only 24,000 or thereabouts of BTR product in market at the moment. If you consider that the Australian government's ambition is for well over 1 million dwellings by 2029, 2030, that equates to quite a shortfall in that particular area. Now, what we are seeing is that it is definitely something that we're going to grow further and further. The size of the market is only dependent upon the amount of activity that we can actually see really get into it. And it is definitely something that not only in 24, but beyond, as we see the entry of other players come into the market, that we see that this is a very desirable asset class that is for the delivery partners, for the end owners, and for the population at large. So definitely something that we want to see come into the market more and more.
Good one, Niall. And Anthony, do you agree with those? Insight from Niall?
Yes, definitely. So we've seen a lot of interest from our client base, both from like institutional end of the market as well as private developers, mainly in understanding how to model their BTR projects and how to integrate systems together. So it is quite emerging, but also with like government sort of introducing different incentives over the last few years, that will just further fuel that interest in that segment. And then you mix that with obviously the increase in net migration, and then you've got low vacancy rates, pushing up interest rates. All that we'll keep on fueling that in next year and beyond.
Interesting. Thanks, Anthony. Look, I'll go to you both with this next question as well, and we might jump back to you now. Look, developers are definitely concerned getting projects over the line now, but how important is it for them to have that operational mindset regarding BTR assets?
This has to be the key in relation to how BTR truly works. It's not a standard build-to-sell product that is just getting rebadged. True BTR has much more of a feel like what you would see around a hotel or, say, student accommodation, where the operational side of things is the secret in regards to how it should actually really feel for the end user. When you do compare, the likes of student accommodation or a hotel, a lot of it comes down to the brand, which really dictates to you as a user what you actually see and feel when you actually walk into that particular facility. BTR is not going to be any different. The real key around this is that it's an asset that is going to be held and operated, and therefore the longer term view has to be considered in regards to it. It is an asset that is actually going to be maintained and kept to a particularly high standard, because that's what the expectation is from the end user. And again, from anyone who's operating any hotel or student accommodation, they'll all tell you the real key is making sure that you're not actually cutting corners in the beginning and sacrificing the long-term game in regards to the operational cost, be it for cleanliness or actual general maintenance. But it has got to be all of those considerations when you're running your feasibility. Otherwise, simply this will not work. At best, at the moment, they're marginal. And that's one of the key things.
Thanks, Noel. Anthony, do you agree with that, just regarding that operational mindset being so significant?
Yes, following on from what Noel said, I like to break it up into sort of two parts. You've got your indirect metrics, and that's the things like, reputation, what the strength of their brand, and an operator's reputation can impact their ability to attract tenants. And then on the other side, you've got the customer service, how responsive are they to tenant issues? Because that then, their level of service can impact their ability to retain tenants. And then when you move away from the indirect type of metrics, you're looking at the financial side of things. Build to rent, longer time frame. The developer's objective is not to sell, it's to hold over a 5, 10, 20-year period. So there's a different mindset when you're looking at the financial performance of that project. So there's more of a focus on yields. Your exposure to interest and debt is a lot longer. So things like your interest coverage and your debt servicing ratios, they become more important. Things like turnover costs, sometimes that's sort of missed, every time that tenant turns over every 12, 24 months, there's a cost associated to bring that apartment back up to its original state or make good. There's also the long-term health, any capex or maintenance costs over time, how does that impact the cash flow as well? So all of those, they're looked, they have to be looked at over that longer 5, 10, 20-year period, which, is different to your sort of traditional build-to-sell type projects.
Interesting. Thanks, Anthony. Look, we'll stay with you, Anthony. Obviously, we've got significant undersupply in the market at the moment, and a strong push on immigration numbers. Do you think those market forces and others will still be, or where do you think they'll be in the next 5 to 10 years?
Yeah, look, net migration is still forecasted to increase, especially, at the post-pandemic levels. So when you combine that with, the increase in interest rates, higher construction costs, that all leads to then a shortfall of housing. So, you need a solution for that. And build to rent is often seen as a strategy to try and tackle that issue. Not only can it provide more supply to the market, but also more choice as well. So it's not just bringing on, assets or stock that people need to purchase, but, there's more rental choice as well. And also, affordability won't go away in the next 5 to 10 years either. And I think we have to also, look at that clear distinction between, the institutional sort of build to rent, which, to a larger extent will be a premium product, and then social and affordable housing. Okay, some people think build to rent is an affordable housing solution. Well, not really. Sometimes it's, some of it is a premium product. But in combination with that and maybe government incentives, it could be seen to tackle that affordability issue in the next 5 to 10 years.
Interesting. Thanks, Anthony. Now, just coming back to you, how are economic forecasts impacting the outlook and expectations for BTR?
Oh, definitely. As Anthony was touching upon there in relation to population growth, you look at the intergenerational report that was released recently from the government, where it's showing that our population is going to be heading towards the 30 million bracket, within the next 10 years, and with an aim that it's actually going to get up to by 2060 up into sort of being 40 million. Housing and dwellings is going to be the key issue in relation to it. Interesting enough, at the moment, we're playing a bit of catch up in regards to it. In 2022, population grew by 2%. But we came off, 2020 and 21, where we had basically no migration whatsoever because of the pandemic. Traditionally, we're sort of taking in roughly around 250,000 in regards to it from migration. So we're playing a bit of catch up, but we're still slightly behind. But it is definitely something that we are actually going to see in regards to it. And as I touched on earlier, with such a low vacancy rate, it is one of those big key things. There's a shift as well, definitely within some of the states from a built to sell product, where that's becoming difficult to gain your approvals, and time to market becomes a really key thing in relation to any asset at the moment. Be it time to actually get approval, time to actually get somebody on board as your delivery partner, time to get it completed, and time to get actually some income coming in relation to it, either, as I said, from just realization from sales, but in this particular case, it's actually a recurring income stream. All of these are definite key drivers in regards to whether the economic forecasts are coming in relation to it. And that time side of things is something that we're hearing again and again and again, that it is the key driver, not necessarily the interest rates that are actually being charged on a construction loan, but the time to actually get the project completed. BTR fits into that perfectly because of its single end user in regards to it. You're dealing with one person or one entity, I should say. You're dealing with it as where it is generally held in all one stratum, so it's not following up through all those particular issues in regards to actually registration of individual strata lots. So all of this actually tends to say that it is actually a more desirable product for a delivery side of things as well as an end user.
Interesting. Thank you, Niall. Anthony, obviously we've seen a lot of our local customers make an effort to travel the globe and check out a number of multi-family or BTR markets globally, from the US to the UK. Others have gone to France and Germany. How do we see Australia compared to those markets, and what do we feel would be a catalyst for change to accelerate future BTR pipeline in Australia?
Yeah, James, there's a lot of blockers in this market that I've identified. One of the obvious ones is on the fiscal side of things is the GST. In that inability to reclaim the GST on capital costs. Straight away that increases your capex by 10%. You have to borrow more money. You can't reclaim that back from the ATO. So straight away, an obvious one to sort of accelerate that pipeline will be to remove that blocker. Other things are like just the accessibility to capital. It's an emerging market. There isn't much comparable data. The banks don't, they're hesitant to lend on that, especially when developers don't even have any runs on the board. So, the fact that, the developers don't have any experience, there's no data, the banks are just less willing to lend. So what does that mean? Private developers then have to look at, alternative sources of funding, such as like a debt fund. But even then, some of those debt funds, they'll have certain sustainability targets they have to achieve as well. So it's not quite simple. Technology is also a big blocker. We see that, clients will come to us and try to work out, what's a good solution. And more often than not, it's like integrating the best of breed, or they'll have to build something from the ground up. So at the moment, technology isn't really robust enough for institutional organizations, or it's not really fit for purpose in this market. Resource, Niall alluded to, student accommodation. It's interesting because we're finding that, in this market, a lot of the developers, they won't have the required skills or experience in built-to-rent projects. So they've had to lean on, getting resources that have had that experience in student housing or co-living to bring them on board and help them with that type of analysis or improve that tenant onboarding process. or developers would have to go and outsource their analysis. And when you do that, it just slows down that appraisal process. Also, absorption. There's with that inefficiency around the systems, whether it's technology and resources, just onboarding those leases takes a longer time frame as well. So that impacts the target absorption rates versus how long it actually takes to onboard those tenants. And benchmarking. So I alluded to how, because it's still an emerging market, banks don't have that data to use as benchmarking. It's harder to sort of measure performance against similar assets, and from a developer's perspective, identify potential opportunities to maximize their value. So when you compare that to places like the US, they have the National Multifamily Housing Council that publish benchmarks. We don't have anything like that here yet. So there's a lot of I think things that are inhibiting the growth of build to rent, and I think just natural growth and emergence of that market will help alleviate some of that, plus with some, I suppose, input from the government as well.
Yeah, interesting. Great insight there, Anthony. Thank you. Just jumping back to you now, we've seen increasing pressure in the office sector, certainly around valuations, also increased vacancies, especially in the B and C grade buildings. Is there a genuine opportunity to convert these to BTR?
Oh, definitely. It is one of those key areas that we will see a lot of activity. The commercial sector is really interesting as what's happening, and there's a lot of mixed messages there. You have to strip into sort of the real detail of the numbers and what's actually happening with their vacancy rate, because there's a flight to quality that is occurring within the commercial market. So we're seeing people, for various reasons, maybe to incentivize staff to come back into the office, maybe to actually meet their ESG requirements, maybe for actually just genuine sort of expansion and desire to actually increase their space. All of these are sort of driving that whole flight to quality, and that end of the market, and the A and the A premium and premium plus side of things, there's quite a lot of activity and people are moving around. Vacancies are still very high, but when you actually look at move in and have a look at the lower quality product, that's when you start seeing that there's actually quite high vacancy rates. And in some of those areas, like where we're seeing maybe up into sort of like an overall sector where, say, 10, 12, 15% vacancy, when you actually look at those lower quality products, that's where you're sort of seeing 30, 40% vacancy rates. So logically, they are the areas that will come under threat. Now, what do you do with them? And they do fit very nicely into this, the BTR side of things. You look at it, generally they're in city centres or near some other pieces of social infrastructure, which is good. You then look at actually the footprint of the buildings. Well, they're not usually huge, so they're not going to redevelop into new commercial office, because again, as I said earlier, that flight into the quality is looking for sort of larger, clearer floor plates. There's also usually issues around car parking, which sort of hits into that build to sell product. But whereas in the build to rent, generally car parking is not much of an issue. It's looking for a location, it's looking for its actual association with other parts of the basically the broader economy, as I said, like social infrastructure. So you're looking at hospitals, universities, things like that. So it fits in quite well in regards to that. There's even potentially some actual upside in regards to the speed, if you can actually get it to fit in within the actual existing structures, and you're basically looking at a repositioning rather than an actual total knockdown and rebuild. So definitely it's an area that fits very nicely into this, much better than some of the other sectors, and definitely something that we'll see developers look at harder and closer across the next short couple of years in relation to it.
Good one, Niall. Yeah, good insight there. Thank you. Look, we might stay with you for this next one. You're obviously working with a number of clients on BTR projects. What are you seeing in terms of emerging design trends? And if you could also touch on just the importance of sustainability.
Yep. Look, some of the key things in regards to it is that if you can, what we're seeing definitely is the design and repetition. So this leads to what you can actually do in regards to modularization, utilization of modern methods of construction, which is not widely adopted across the residential and living sector in Australia at the moment. If you look at what we see in Europe and parts of Europe, I think the closer analogy of what we're seeing in the BTR market for Australia is much closer to what's happening in the UK, and probably where we are is where the UK is maybe 12, 15 years ago. And there is this tendency to look at America because it's a much more developed market and it's a broader multifamily offering, but we're not there yet. And I think our needs and desires are slightly different as well. So what does that actually mean when you design a BTR development? A lot of it is about repetition. A lot of it is about standardization. But there's also some flexibility that has to come into it. From an operating side of things, if you have got more standardization and you're away from the bespoke joinery pieces and units in regards to it, it allows you that ability to carry maybe minimal amounts of spares, but also it also means that you actually are more likely to be able to get something off the shelf rather than having to have something made from scratch in regards to it. So therefore, your time of repair and maintenance is dramatically reduced. These are definitely concerns that are coming into it in the design. And my essay actually been addressed very well in what we're seeing in the market at the moment. A lot of it, again, comes down to the design layouts to actually minimize the energy use. So good design in regards to both thermal gain and actually solar access means that the amount of energy that has actually been consumed is trying to be kept to a minimum. And that definitely is a trend that we are actually seeing is very desirable for both end users and also asset owners.
Good one, Noah. Good insight there. Thank you. This next question will come to you both, but I might jump back to you here, Anthony. Just as the sector evolves, what are the BTR models of the future?
Yeah, look, we're seeing some of that evolve right now, actually. So there's a company called Assemble Communities. And they've got this Assemble Futures model, which is basically a build, rent, buy approach. And so it's a different take on the build to rent. And they sort of market as a different or an alternative way to ownership. And it essentially allows owners or residents to rent for 5 years and then have the option to purchase at the end of that period. So that's an interesting concept that we might see grow in the future. Looking at sort of the mid-tier sort of private development market, we've already seen this happen. You know, they're going with a hybrid strategy where they want to tip their toes into the market. They haven't had any experience, and whether it's their primary strategy or it's their fallback strategy, they might have part of their project that's built to sell and the other part's built to rent. It helps them obviously minimize their exposure to risk. So yeah, we might see that sort of grow sort of in that mid-tier private developer market. But I also think, like I said, traditionally build to rent, it's been sort of seen as like a premium product, a premium rental product. I think, affordability is going to be a huge issue. It already is, and it's probably going to grow into the future. And I think we'll see more government involvement in that area. We've already seen Queensland run a pilot project where they're basically providing subsidised rent by as much as 25% for the developers to provide affordable housing. So without that incentive, it just makes it difficult to stack up their projects. So yeah, that's what we're already seeing some of that now, but I think that will definitely grow in the future.
Interesting. Thanks, Anthony. Now, I'd like to get your thoughts on that as well, just about the BTR models of the future.
Yeah, I think, as I mentioned earlier on, we start looking at what's happened in more developed markets, and you see in trends, say, let's say in Europe. I'm not advocating for this or think that this will actually happen because of other issues, but in the likes of Germany and some of the Scandinavian countries, build to rent, you basically are getting almost like an empty shell. It can be that you actually fit out the space yourself to your own quirky needs in amount. It might be wet areas are done out, so you'll have your bathroom and that will come into it. But your kitchen, you can actually buy a flat pack kitchen, bring it in yourself. You have to return it, like any other lease in regards to you return it to the state that you got it in. generally when you actually took acceptance on it, but you can paint it, you can do all those sort of things. See that probably been a little bit too far down the road for it, but I do see that the flexibility within the product that we are seeing in the likes of, again, like the UK, parts of France, where it can be that, say, two adjoining units can get reconfigured where there might be a breakout panel. It's a bit like the dual key sort of scenario that you'd see in some service apartments, as it is the same idea where, as the families grow or the requirements grow, that you end up that you actually can grow out into the actual the space itself. The idea is that once you actually have your occupier in place, that they want to stay with it. And again, touching back to where we said earlier on about the brand and why people actually will stay in these long term is because they're actually enjoying the service that they're getting, and therefore the brand makes them feel good in regards to it. They like the design, but it truly becomes a sense of community. And because they're longer term leases, they actually are something that will actually be that they'll stay and grow within for a relatively longer period than it might have been under just a straight rental. The other side of things that will also see happening is that as our social infrastructure grows out, and there's been a large growth in that in the East Coast, particularly in, say, the Melbourne and Sydney markets. But as we see the growth of the social infrastructure in the likes of Queensland, Perth, and South Australia, and Adelaide, around those we'll see an emergence of a build to rent akin to sort of what you'd see, say, in postgraduate accommodation in, say, universities, where slightly larger than what it is, making sure that it actually fits in for those essential workers, but because of size, it'll actually be at a certain price point that'll make it a bit more affordable and therefore more desirable, because a lot of these things are actually really driven by the workers that are there for the success of those pieces of social infrastructure. So really, really important to see how that actually comes around, and we develop in it as we see it change quite a bit in regards to it.
Interesting, Niall. Thank you so much for that feedback. Look, let's take a question from the audience here. We've had a number of questions come through. Let's take one. If anyone misses out, I'll ensure that either yourself, Niall, or Anthony will get back to them. And then I'd like to come to you both for some final thoughts. Okay, let's take one here. What are the greatest challenges in getting projects to stack up? We might start with you, Niall.
Well, what we're seeing really is it's very common around the simple things of the likes of the percentage of the land cost. When you look at actually what the cost of land per unit per box in regards to it, say in Melbourne, it's typically around about 12% of the total development cost, whereas in Sydney that's up to 35%. And that really gives you an idea of why we're seeing a lot of the emergence of this product class in the Victorian market way ahead of what we're seeing in the New South Wales market. It's just getting too hard to stack up in regards to it. Definitely they're one of the key things economically, and the other side of things is just the time to delivery and the delays in approvals. As I said earlier on, time is now the big thing that is actually really hurting feasibilities, because it's the holding costs are really just too much in regards to it, eking away at that very, very narrow margin.
Okay, thank you, Niall. Anthony, I'll throw that one over to you. Challenges in getting projects to stack up from your side?
Yeah, I agree with Niall there on the land. Usually, like, your land acquisition cost is usually what makes or breaks a feasibility. So it's important. It's quite critical. But yeah, we're already seeing that some BTR schemes are either being deferred or even being completely abandoned. As part of the repricing of land values. Then the next obvious ones will obviously be construction costs, and it's not just the upfront construction costs or the costs related to the capex upfront, but also the ongoing costs, the maintenance costs involved, any refurbishment works that are forecasted 5 years down the track, say, and then interest rates. As you go into that hold period, interest is one of the biggest expenses throughout that whole period. So, all that impacts the viability of the build to rent projects. And even just speaking to some of our, my colleagues overseas, they're already seeing evidence of how construction costs are making, build to rent projects harder to make viable. They're seeing developers in Vancouver trying to get away with not building any parking, or even reverting to wood frame construction rather than concrete to make the project stack up. And even it's still staying in Canada, like they're even seeing different legislation around this concept around rental replacement, where basically, if they're going to an asset that's, say, it's at its end of its economic life, and they're repurposing it to build to rent, they're being told that, well, you have to actually deliver the same, whatever you're replacing, you have to deliver the same, pretty much the same structure or characteristics at the same rental value. So when you're trying to knock down an existing residential, refurb an existing residential multifamily building that it's end of its life, and you want to try and deliver a premium product, but you've got these restrictions set on you, then it just makes it a lot harder to stack up. So yeah, hopefully we don't get those type of restrictions or legislation in this market, because that would just, I suppose, fuel to the inability to grow it in our market.
Yeah, very interesting, Anthony. Thank you. Look, let's get some final thoughts from you both. Noel, we can start with you, please.
I think picking up on what definitely Anthony was sort of touching there in regards to it, making sure that you actually can control the costs in construction is key. It's one of the biggest input costs in regards to this. As I said earlier on, my thoughts in relation to it is standardization, modularization, utilization of modern methods of construction to try and actually speed the projects up, and definitely trying to actually reduce that time that you're actually in development before you actually get to the realization side of the equation is key. But again, and touching what Anthony just said, we have to be very cognizant of the fact that these are a held asset that is operating, and cutting the corners at the beginning or actually going with the actual cheaper option at that earlier stage to push the cost into the recurring side of things is not a good outcome and not a good idea, because realistically, that's actually what will come back and actually be a negative for you as you go into the operational side of it. So having a whole of life consideration is going to be the key in changing the mindset for a lot of people that are in the residential market. And as I said earlier on, this leads an awful lot more towards what we would see from the hotel operation side of things, and actually making sure that you have an operator and actually engaging with the operator at the very outset is really going to be a big influence on what's happening, not only with the design, but with the construction cost, and ultimately with your overall feasibility.
Thanks, Noel. Very interesting. Anthony, over to you for some final thoughts, please.
Yeah, look, you definitely need that longer term mindset, especially when you are doing that build to rent feasibility. It's not all about, what's happening now, where rents are now, where vacancy rates are now, what's the supply in the market now. You have to look at where things will be in, say, 4 years' time, when the building's completed, and also beyond that, where are vacancy rates going to be in the future? What type of infrastructure is coming online in my area? That all impacts what my assets cash flow will look like in 3 to 5 years. Is it going to be any new supply coming online? How will that impact my cash flow? More competition. Or, how will renovations or capex works help improve my value? So there is that longer term mindset. It's not a 2 to 3 year play. We're not building and getting out. We're committing for the longer term. And for that to be successful, you have to understand, 5, 10, 15-year timeframes, how everything directly and indirectly will impact your project and your asset.
Interesting. Thank you, Anthony, for sharing those thoughts. Look, as I expected, great conversation today. Clearly one we could spend at least another hour on, and no doubt, I'm sure this conversation will continue as the sector gains momentum with increased interest from investors and developers. I want to thank you both for taking the time to share your insights today, and also thank the audience for joining today's webinar as well. You will receive a copy of the recording, so stay tuned for that. And please feel free to reach out to Niall or Anthony following this webinar if you have any questions or you wish to discuss your next project. Thank you again. Have a great afternoon.
Thank you.